Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 5 from the book Crypto Swing Trading by Jide George. It has been created with the help of AI. The chapter is titled Risk Management. You can read the original post at samfury.com.
All right, strap yourselves in because today we're taking a deep dive into the world of crypto swing trading.
It's going to be a wild ride.
Yeah, but before we start chasing those sweet, sweet gains...
Got to talk about something else first.
Oh, absolutely. We need to talk about risk management.
Yeah, risk management.
We're going to be using G. George's Crypto Swing Trading as our source.
A fantastic book.
It is.
It's full of wisdom.
And we're going to be focusing on a chapter all about, well...
staying safe out there.
Exactly, risk management.
Not the most exciting topic.
It's not a Lambo.
No.
It's not the next 100x coin. But
probably the most important.
Yeah, for sure. So why don't you tell everybody why risk management is so crucial, especially
in the world of crypto.
Especially in the crazy, wild world of crypto.
Yeah, crypto.
It's a roller coaster.
It's like the Wild West out there.
Oh, it is.
It's volatile, unpredictable.
You wake up one morning.
Yeah, and your portfolio's up 20%.
Then you go to bed that night.
And it's down 30%.
Yeah. So without a plan.
You're kind of just gambling.
Without a plan.
You're basically just throwing darts blindfolded.
Yeah, and hoping you hit the bullseye.
Right.
Which probably won't happen.
Yeah, most likely not.
So risk management is about...
taking control.
Taking control.
Making calculated decisions.
Yeah, and not letting those emotions...
like fear and greed.
Yeah, like FOMO.
FOMO. Oh, man. Fear of missing out.
The ultimate killer.
It is so powerful.
It is. Seeing all your friends.
Making money.
Yeah, buying the next hot coin.
And you just think you have to get in now.
You just got to get in right now. That's how people get regs.
That's how you end up losing your shirt, right?
Absolutely.
So a risk management plan
is like having a set of rules.
It's like having a set of rules.
Keep you in check.
Keep you on the straight and narrow.
Exactly.
When the market is going haywire.
Keeps you grounded.
When everyone else is losing their minds.
When everyone else is panicking. You can just be cool as a cucumber.
You can just say, nope, I have a plan.
Sticking to my plan.
Sticking to my plan.
All right, so first things first. Let's talk about position sizing.
Yeah, position sizing, the foundation of risk management.
Okay, so this is...
how much money?
Yeah, how much money?
You put into each trade.
You're going to put into a single trade.
So you don't blow up your account.
Now, George, he introduces this golden rule.
Yeah, the 2% rule.
The 2% rule. So this means...
never risk more than 2%.
never risk more than 2% of your entire trading capital on any one trade.
That's it.
So if you have, let's say, $10,000...
to play with.
Yeah. $10,000 that you're using for crypto trading.
Yeah.
The maximum you should ever risk on any single trade
is $200.
$200, just 2% of your $10,000.
Exactly.
Okay, that's simple rule.
Simple but powerful.
Powerful.
It's all about protecting yourself from those big losses.
Those catastrophic losses can happen so easily in crypto.
Oh, especially in crypto.
All right, so we have that 2% risk limit.
Right.
But how do we actually figure out...
yeah, how many coins can you buy?
How many coins you can buy, right. Because it's not as straightforward as just...
right, it's not just 2% of whatever the coin price is.
Exactly.
To figure that out, we need two pieces of information.
Okay.
Your entry point, which is the price you buy the coin at.
Right, so the price you buy in at?
Yep, and then your stop loss.
Ah, yes, the trusty stop loss.
The stop loss.
Tell everybody what a stop loss is.
Yeah, your stop loss is that price where you automatically sell to limit your losses.
Right, you set it ahead of time.
Ahead of time.
So you don't get caught up.
In the emotion of the moment.
Yeah, you don't panic sell.
Exactly.
You don't do any of that.
You let the system do the work for you.
So the difference between your entry point and your stop loss
is your risk per coin.
Is your risk per coin. Got it.
Let's say you're buying a coin at $50 and you set your stop loss at $45.
So that's $5.
That's $5 risk per coin. So with our $200 risk limit from our 2% rule,
okay,
we could buy 40 coins.
40 coins?
Yeah. $200 divided by that $5 risk per coin.
Equals 40 coins. I'm with you.
Easy math.
Yeah. It's a simple but powerful calculation.
It really is.
That helps you manage that risk.
And stay in the game.
Okay, so...
so we've talked about position sizing.
Yeah, so we've got that.
Limiting how much we can lose.
Limiting our losses.
But trading is also about...
making money.
making money.
Right, hopefully.
Hopefully, we need to think about...
now we got to think about the potential rewards.
yes, the reward side.
Of these trades.
And that's where the risk-reward ratio comes in.
Okay, risk-reward ratio.
That's probably my favorite concept in trading.
Sounds cool.
It is cool. It's not just about minimizing losses.
Yeah, it's not just about preventing those big losses.
It's about making sure
Making sure the potential wins
are big enough
are big enough.
to justify the risk.
Right, I mean...
Why risk $200
Yeah, why risk $200?
to potentially make $50?
Right. That doesn't make a lot of sense.
Not really. You want those wins to be meaningful.
You want the juice to be worth the squeeze.
Exactly.
So what kind of risk-reward ratio should we be aiming for?
George recommends.
Okay.
A minimum of 1.2.
1.2? So that means...
For every dollar you risk, you're aiming for at least $2 in potential profit.
At least $2 in profit.
That's the minimum.
Okay. And this helps you stay profitable even
if only half your trades work out.
Oh, wow.
Yeah, because those wins...
They'll more than make up for.
Yeah, those big wins will offset...
the losses.
The losses.
I like it.
Yeah, it's powerful.
Okay, but what if...
Yeah.
What if we put all of our eggs in one basket?
Ah, the diversification question.
Right. So let's say we find this amazing altcoin.
Okay.
And we think it's going to the moon.
Right.
But then...
something happens.
it crashes and burns.
Rug pull.
And we lose everything. Ouch.
That's where diversification comes in.
Yes. Diversification.
Right.
It's not just about...
spreading your bets.
Yeah, it's not just about buying a bunch of random coins.
Exactly. It's about understanding
Your relationships.
between different cryptocurrencies.
Okay, so tell me more about that.
All right. So imagine you have a portfolio
Okay.
with 10 different altcoins.
10 altcoins? That sounds pretty diversified.
Sounds good, right?
Yeah.
But what if all 10 of those coins tend to move in the same direction
As Bitcoin.
as Bitcoin?
Uh-oh.
Have you really diversified?
I see what you mean. It's like
having 10 different flavors
of the same ice cream.
of vanilla ice cream.
It looks different.
It might look different.
But it's still...
It's still all vanilla.
Yeah, and if you don't like vanilla...
You're in trouble.
you're in big trouble.
Yeah.
So true diversification...
About finding assets
that are not...
closely correlated.
Okay, so...
You want some assets that zig.
And some assets that zag.
Exactly.
So when Bitcoin is having a bad day...
maybe your DeFi tokens are doing great.
Or maybe your NFTs are going crazy.
It's all about balance.
Right, so it's not just about how many coins you own.
Nope.
It's about how those coins...
interact with each other.
interact with each other and with the market as a whole.
The whole ecosystem.
The whole ecosystem.
Yeah.
Okay.
And here's another pro tip.
Okay, hit me.
Don't be afraid to hold some of your capital
Okay.
in cash or stable coins.
In cash or stable coins. Now, why would you want to do that?
Because stable coins, as the name suggests,
They're stable.
they're stable.
Yeah, they're not going
They're not going to 100x overnight.
They're not going to make you rich quick.
Nope.
So why would you want to hold them?
Well, think about it this way.
Okay.
Stable coins give you flexibility.
Sure.
If the market takes a sudden dip,
Which it does.
which it does, you'll have dry powder ready to buy those dips without having to sell your other assets.
At a loss. I see. So it's like having a secret weapon.
It's like having a secret weapon,
Stashed away.
just waiting for the right moment.
Okay, I like it.
And it can also be a good psychological tool.
How so?
Just knowing you have that stability
Okay.
can help you avoid making those impulsive decisions.
Yeah, those emotional decisions.
Yeah, when the market's going crazy.
Because you know you have that stable base.
You have that safety net.
All right, so we've covered position sizing.
Yep.
We've covered risk-reward ratio. We've covered diversification.
2 pillars of risk management.
What else do we need to factor in?
Well, let's talk about something that every trader will face at some point.
Oh, this sounds scary.
It can be, but it's part of the game.
All right, lay it on me.
Drawdowns.
Drawdowns.
Yeah, drawdowns.
What are those?
A drawdown is simply when your portfolio
Okay.
drops from its peak value.
Okay, so it's like
It's like watching your carefully constructed crypto castle
crumble.
crumble brick by digital brick. Ouch. It can be painful.
So it's basically like you're up.
You're right.
You hit a new all-time high.
You're feeling great.
And then the market turns.
And your portfolio starts going
Yes,
down.
and you watch those profits disappear.
Okay, so drawdowns are basically inevitable
They are inevitable.
in the world of crypto.
You can't escape them.
So what separates the successful traders from the ones who get ricked?
Is how they manage those drawdowns.
It's not about avoiding them completely,
You can't avoid them.
right? Because you can't predict the market.
No one can.
So it's about how you handle them.
It's about having a plan.
Okay, so tell me more about this plan.
So you can set
The specific
predefined thresholds for when you'll reduce your position size.
So like if your portfolio drops a certain percentage,
Exactly.
you automatically
reduce your exposure.
Okay, so you're not just sitting there, you're not just watching it burn.
Panicking.
You're taking action.
So let's say my portfolio drops.
Yeah.
10%.
10%
From its peak.
from its all-time high.
Should I be hitting the panic button?
Not necessarily.
Okay.
It depends on your individual risk tolerance
Okay.
and the overall market conditions.
The having a plan.
Having a plan helps you
Stay calm.
stay calm
Collected.
and make those rational decisions
Yeah.
instead of emotional ones.
So if my plan says,
All right?
to reduce my position by 50%
Okay.
when my portfolio drops 10%,
Yeah.
I stick to that plan,
You stick to the plan,
even if it feels scary.
even if it feels scary.
It's all about taking the emotion out of it.
That's the key.
Okay.
And this brings us to what's arguably
The hardest part.
the most challenging aspect.
Risk management.
Yeah, mental fortitude.
Mental fortitude.
The mental game.
This is where it gets really interesting.
Yeah, because
Yeah, you can have all these rules
you can have the perfect plan,
written down,
back-tested everything.
but if you don't have the discipline to actually follow it,
Yeah, if you can't stick to it,
and it's all for nothing.
it's worthless.
So how do we actually develop
Right.
that mental discipline?
Yeah, how do we build that mental fortitude?
Because it's easy to get
Oh, it's so easy.
caught up in the hype,
The hype,
the fear.
the fear, the greed, all of it.
Oh, yeah.
And then you start making
you start making bad decisions.
impulsive decisions.
You start moving your stop loss.
Ah, classic mistake.
You start chasing pumps.
FOMOing in at the top.
Yeah, or you just say, just this once.
Just this once, I'm going to break my rules.
Yeah, I've been there.
We've all been there.
It rarely ends well.
It never ends well.
So how do we
avoid that trap?
that track?
It starts with recognizing
Recognizing what?
your own psychological biases.
Okay, our psychological biases.
Are you prone to FOMO?
Do you have trouble cutting your losses?
Do you get too greedy?
Do you chase pumps?
Do you panic sell?
Once you understand.
Yeah, once you know your weaknesses,
Okay.
you can start developing strategies
To overcome them.
to overcome them.
Okay, so if I know
If you know
I have a tendency to chase pumps.
you chase those green candles,
Yeah, I get all excited.
I see those numbers going up
And I just buy in
at the very top.
at the very top.
Oof.
Maybe I need to set a rule
Set a rule for yourself.
that I can't enter a trade
Yeah.
until the price
Is calm down
is stabilized.
for a certain period of time.
So I'm not just FOMOing.
You're not just buying on emotion.
Oh, okay, that makes a lot of sense.
It's about putting those systems in place
Systems, I like that.
Yeah.
Systems to prevent you,
to protect you
to protect you
from yourself.
from your own worst enemy.
So you might also want to consider
You could also
journaling your trades. Journaling, yeah, it sounds kind of boring.
journaling. It's like
Yeah.
therapy for your.
Yeah, therapy for your crypto addiction.
I like that.
But it can be really helpful
How so?
because it helps you track your emotions, identify patterns
Oh,
in your behavior. You can see when you're making those emotional decisions, and then you can adjust
adjust your strategy.
your behavior.
Yeah, become more self-aware.
Self-awareness is key
It is.
in trading and in life.
So we're talking about developing that discipline
The discipline.
to execute your plan.
Even when it's hard, even when it feels like the market's against you.
Like you want to do the opposite.
Yeah, that's when you know
You know you're on the right track.
you're being tested and you have to pass the test.
It's all a test.
It is. Trading is a test.
It's a test of
your patience,
your discipline.
your emotions.
Okay, this is fascinating stuff. I'm realizing that
Mhm.
risk management is as much about psychology
Oh, absolutely.
as it is about numbers.
Yeah, the numbers are important.
The numbers are important.
But if you can't control your emotions,
You're going to lose.
you're going to get rigged.
Yeah.
And here's another important
Okay.
psychological aspect to consider:
Hit me.
managing expectation.
It's not about being a crypto wizard.
Right, you're not going to predict every move.
No crystal ball, fortunately.
Yeah.
Even the most successful traders
Yeah,
experience losses.
they lose money.
It's part of the game.
It's part of the game.
It's inevitable.
So the key is to
Accept those losses
accept the losses
as part of the journey.
and not let them derail
Your overall
your
strategy.
long-term plan.
That's actually really reassuring to hear.
Yeah.
Because I thought you had to be like some kind of genius to make money in crypto.
But you don't.
You don't need a crystal ball.
You don't.
You just need
A solid plan.
a solid risk management plan
The discipline to stick to it.
and the mental fortitude. All right. I'm starting to feel like I have a better grasp on this whole risk management thing.
It's a journey.
But I'm sure there are times
Oh, there will be times
where I'm going to feel overwhelmed.
yeah,
I'm going to feel frustrated.
frustrated.
Maybe I'll even be tempted to throw my computer out the window.
I've been there.
So any
That's no
tips
problem.
for dealing with those moments?
Yes,
When you're
yeah.
just like, I can't take it anymore.
First of all, it's crucial
Okay.
To prioritize your mental and emotional well-being.
Oh, sir.
Trading should be a means to an end,
Okay.
not a source of stress. It's not supposed to be your life. You shouldn't be checking the charts
24/7?
every 5 minutes.
Okay.
You got to take breaks.
Take breaks.
Step away from the charts.
Step away from the computer.
Go outside.
Get some fresh air.
Spend time with loved ones.
Do something you enjoy.
Yeah, find activities that help you de-stress
Okay.
and recharge.
So taking breaks is important
Taking breaks is crucial.
because it's easy to get burned out,
Oh yeah, especially in crypto.
especially in crypto.
It's so fast-paced.
And it's 24/7.
Yeah, there's always something happening.
Okay, so taking breaks, it's not just about protecting your capital.
It's protecting your sanity.
Okay, this has been such an eye-opening conversation.
Ridiculous.
It's clear that risk management is the foundation.
Absolutely.
But before we wrap up
Yeah.
our deep dive
Into Jide George's wisdom.
into his insights,
Yeah.
is there anything else we should keep in mind?
One last thing.
Okay, hit me.
Risk management is not a set it and forget it kind of
Yep.
thing. You can't just write your plan
And put it in a drawer.
and never look at it again.
Yeah.
It's a living document. It needs regular checkups. It needs to be adjusted
Right.
as you learn and grow,
As you gain experience.
as the market changes,
As your life changes.
just like we would with any other part of our trading strategy.
Okay, what are some things that might signal that it's time?
To tweak our risk management approach.
It could be anything
Okay.
from changes in market conditions.
Okay, so if the market is super volatile, you might want to tighten up, reduce your position sizes.
If the market is more stable,
Yeah, if things are calmer, maybe you can loosen up a bit, take on a little more risk.
it also depends on your personal financial situation.
Yeah, let's say you started out
Very conservative.
2% risk per trade,
2% risk per trade.
but over time,
Yeah.
you gain more
Extra
experience.
confidence. Maybe you've even made some money.
You've got more capital to work with.
So it makes sense
It makes sense.
that our risk tolerance might
It will evolve
over time.
along with our trading journey
The key is to be aware
of those shifts.
and adjust your plan accordingly.
Don't just be stuck
Yeah, don't be rigid.
in your ways.
Be flexible.
Be adaptable. That's the key to success.
And don't forget to track your performance. Analyze your wins and losses.
Learn from your mistakes. All right. Well, we've covered a lot today.
So much good stuff in there.
Yeah.
And thank you to our listeners.
Of course. Thanks for listening.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.